silver just hit $79 per ounce for the first time in history. And while mainstream financial media celebrates this as a supply and demand story or industrial demand from solar panels and electric vehicles, what they're not telling you is that silver reaching $79 exposes the biggest lie your government has been telling for 50 years, which is that inflation is transitory and paper currencies are stable stores of value. Because when silver moves from $20 to $79 in less than 2 years, that's not silver becoming more valuable. That's the dollar becoming worthless. And the implications go far beyond precious metals, because the same monetary debasement that's driving silver to record highs is creating a massive bubble in technology stocks that are valued based on future earnings in dollars that are losing purchasing power every single day. And when this bubble pops, and it will pop, you're going to see the biggest wealth destruction in technology sector history. And by the end of this video, you'll understand exactly why silver at $79 is a warning signal that the entire financial system is breaking, why government's inflation lies are being exposed in real time by hard assets, and why the technology stocks that everyone thinks are safe investments are actually the most dangerous assets you could hold right now. The story of how silver reached $79 begins not with mining supply or industrial demand, but with monetary policy, specifically with the decision in 1971 when Richard Nixon closed the gold window and ended the last link between the dollar and precious metals. Because before 1971, dollars were convertible to gold at $35 per ounce, which meant there was a constraint on how many dollars the government could create. But after Nixon broke that link, the Federal Reserve gained unlimited power to create dollars backed by nothing except government promises. And for the first few decades, this seemed to work fine because global demand for dollars as the reserve currency absorbed the new supply. But eventually you reach a point where you've created so many dollars that even global demand can't absorb them without prices rising. And that point was accelerated dramatically during COVID, when the Fed created over $5 trillion in 2 years. More money than existed in the entire economy before 2000. And all those dollars are chasing the same amount of goods and services, which means prices have to rise. And silver, which has been money for 5,000 years, is simply reflecting the destruction of the dollar's purchasing power. Here's the government's biggest lie that silver at $79 exposes. They claim inflation is caused by supply chain disruptions, or corporate greed, or Putin, or whatever convenient excuse exists at the moment. But the reality is that inflation is caused by one thing and only one thing: the creation of new money faster than the creation of new goods and services. And when you create $5 trillion in 2 years, you get inflation. Not because of supply chains, but because you destroyed the currency, and the proof is in the silver price. Because silver, like gold, has relatively stable supply. Mines produce roughly the same amount each year with small variations, and industrial demand while growing is predictable. So when silver triples from $25 to $79 in 2 years, that's not a supply shock. That's a currency crisis, and it's exposing that every time the government claims inflation is transitory or under control or caused by external factors, they're lying. Because the real cause is the monetary expansion they themselves created and continue to create every time they run deficits, and the Fed monetizes the debt by buying treasury bonds with newly created money. Now let me show you why this matters for technology stocks and why silver reaching $79 is a warning that tech is about to crash. Technology stocks are valued using discounted cash flow models which project future earnings and discount them back to present value using an interest rate. And the logic is that a company like Nvidia or Tesla or Microsoft will generate profits in the future, and those profits are worth something today. But here's the problem. Those future profits are in dollars. And if dollars are losing purchasing power at an accelerating rate, then future dollars are worth less than the models assume, which means technology stocks are massively overvalued. Let me make this concrete. If Nvidia is valued assuming it will generate $100 billion in profit 10 years from now, and your model discounts that at 5%, you get a present value of about $61 billion. But if inflation is actually running at 10% because of monetary debasement, then that $100 billion in future dollars is only worth $39 billion in today's purchasing power, which means NVIDIAS valuation should be cut in half. And this applies to every growth stock that's valued on future earnings. They're all implicitly assuming dollar stability that silver at $79 proves doesn't exist. But here's what makes the tech bubble even more dangerous. Technology stocks have become the ultimate inflation hedge in investors' minds. People buy Nvidia and Tesla and Microsoft thinking they're protecting themselves from inflation because these companies can raise prices and grow earnings. But this is backwards. Tech stocks are denominated in dollars, and when you destroy the dollar's value, you destroy the basis for valuing tech stocks. And what you're seeing now is a setup identical to 2000 when the dot-com bubble burst. Everyone believed internet stocks would go up forever because the internet was the future, which was true. But valuations had gotten so disconnected from reality that even great companies collapsed 90% when reality reasserted itself. Today we have the same dynamic. AI and technology are real and important for the future. But the stocks are valued assuming stable dollars and perpetual growth in a currency that's being actively destroyed. And when the market realizes this disconnect, the crash will be catastrophic. What would you do if you discovered that the technology stocks you think are safe investments are actually leveraged bets on the dollar maintaining its value? And silver reaching $79 proves the dollar is collapsing. This is the question every investor needs to confront right now, because the conventional wisdom says own tech stocks for growth and own bonds for safety. But both tech stocks and bonds are dollar-denominated assets that get destroyed when the currency collapses. And silver is telling you the collapse is already happening. If you're starting to understand that silver at $79 isn't about silver supply, but about currency destruction. And that currency destruction makes technology stocks far more dangerous than anyone admits. Stay with me, because what comes next will show you the specific mechanism through which the tech crash will happen and why most investors will be completely unprepared for what's coming. Subscribe now, because very few people are connecting these dots between precious metals and equity valuations. The mechanism through which silver's rise will crash technology stocks works through interest rates and what's called the equity risk premium. When silver and gold surge, it signals that investors are losing confidence in paper currencies and government bonds. And when confidence in bonds falls, interest rates have to rise to attract buyers. And rising interest rates are catastrophic for technology stocks because they increase the discount rate used in valuation models. Let me show you the math. If you're valuing tech companies' future earnings and the discount rate goes from 5% to 8%, valuations drop by about 30 to 40%. And if rates go to 10%, which is likely if the dollar crisis accelerates, valuations drop 50% or more. And this is why the Fed has been so desperate to keep rates low for the past 15 years. They know that if rates rise to levels that reflect actual inflation and currency risk, the entire stock market, but especially technology stocks, will collapse, but they can't keep rates artificially low forever. Eventually, reality forces rates higher, and silver at $79 is telling you we're approaching that moment. Here's the specific timeline of how this crash will unfold based on historical precedent and current conditions. First, precious metals continue rising as more investors recognize the currency crisis. Silver goes from $79 to $100, and gold goes from $100 to $4,000. This happens over 6 to 12 months, and the financial media dismisses it as a speculative bubble in commodities. Second, Treasury bonds start selling off because foreign holders, especially China and oil producers, realize they're holding assets that are being inflated away, and when bonds sell off, yields rise, and the 10-year Treasury yield, which is currently around 4.5%, rises to 6 or 7%. Third, the Federal Reserve faces an impossible choice: either let rates rise and watch the stock market crash, or intervene to buy bonds and keep rates low, which requires creating even more money and accelerates the currency crisis. And historically, the Fed always chooses to print more money. But this time, that choice will break the dollar's credibility completely. Fourth, as rates rise, or as the market anticipates, the Fed will have to capitulate and print massively. Technology stocks start crashing the highest valuation. Names go first. Companies trading at 50 or 100 times earnings drop 30 to 50% in a matter of months, and investors panic and sell everything, which accelerates the crash. Fifth, we get a full-blown crisis where tech stocks are down 50 to 70%, bonds are selling off, and precious metals are surging, and the government responds with more money printing and bailouts, which confirms that the currency is finished. And at that point, silver and gold go parabolic, while paper assets continue collapsing. The parallels to previous currency crises prove this pattern repeats with mathematical precision. In Weimar Germany in the 1920s, as the mark collapsed, gold priced and marks went parabolic, while stocks denominated in marks became worthless. German companies were still producing goods, but the currency destruction made stock ownership pointless because your gains in marks were losses in real purchasing power. In Zimbabwe in the 2000s, as The Zimbabwe dollar hyperinflated gold and silver held value while the Zimbabwe stock market went to infinity in nominal terms, but zero in real terms. You could make millions in the stock market and still not afford bread because the currency was worthless. In Argentina, over the past 20 years, every time the peso collapses, precious metals surge, while peso-denominated assets lose real value, even if nominal prices rise. This is the pattern: currency, destruction, benefits, hard assets, and destroys paper assets. And the United States is not exempt from this pattern just because the dollar is the reserve currency. In fact, being the reserve currency makes the eventual crash worse because there's more dollar-denominated debt globally that will all rush for the exits simultaneously when confidence breaks. Now let me address the counterargument that technology companies can protect themselves from inflation by raising prices and growing revenues. This is partially true for companies with pricing power like Apple or Microsoft, but it's irrelevant for valuation purposes because the issue isn't whether revenues grow in nominal dollars. The issue is whether those nominal dollars retain purchasing power, and they don't. So even if Nvidia doubles its revenue in 5 years, if the dollar loses 50% of its value in that time, then shareholders haven't gained anything in real terms. They've just maintained purchasing power at best, and more likely they've lost because stock valuations will fall as discount rates rise. The companies that will survive are those with hard assets or pricing power in essential goods. Energy companies, mining companies, agricultural companies, food producers. These are the stocks that can actually maintain real value during currency crises because they produce things people need regardless of what the currency does. But technology companies, especially those focused on discretionary spending or advertising or luxury goods, will be destroyed because their entire business model depends on a functioning currency and credit system. And when that breaks, their earnings disappear and their stocks crash. Here's what the smartest investors are doing right now. While silver is at $79 and tech stocks are still expensive, they're selling technology exposure and moving into hard assets, not just precious metals, but also energy stocks, mining companies, agricultural land, commodities, anything that represents real productive capacity or resources rather than claims on future dollars. Warren Buffett, who everyone thinks of as a stock market investor, has been selling stocks and building Berkshire's cash position to over $150 billion. And while cash seems like a terrible inflation hedge, he's waiting for the crash to buy hard assets at distressed prices. Buffett understands that when the bubble pops, everything will be on sale, and that's when you deploy capital. Not now when tech stocks are at all-time highs and silver is screaming that the currency is collapsing. Ray Dalio of Bridgewater has been explicitly warning about currency debasement and recommending gold and hard assets as protection. He's called the current environment the end of the long-term debt cycle, where governments have borrowed so much that the only way out is to inflate the debt away, and he's positioned his funds accordingly with significant precious metals exposure. So what should you do if you're holding technology stocks right now while silver is warning of impending collapse? First, understand that timing markets is difficult and you might be early. Silver could go to $100 and tech stocks could still rally another 20% before crashing. But the risk reward is clearly negative. You're risking 50% downside for 20% upside. That's a terrible bet. Second, consider reducing or eliminating exposure to the highest valuation tech stock. Anything trading above 30 times earnings is priced for perfection and will be destroyed when rates rise or when the market reprices for currency risk. This includes most of the NASDAQ and the Magnificent Seven stocks that have driven the market. Third, shift into assets that benefit from currency destruction. Physical gold and silver are obvious choices, but also consider energy stocks, mining, stockies, and commodities, which will outperform dramatically when the dollar crisis becomes obvious to everyone. Fourth, if you must stay in equities, focus on companies with hard assets, pricing power, and low debt. Old economy companies like energy producers, utilities, consumer staples. These are boring, but they survive currency crisis. Fifth, build cash reserves, but not in long-term bonds. Keep money in short-term treasuries or money market funds that can be quickly deployed when assets go on sale during the crash. The final piece of evidence that silver at $79 is warning of imminent tech crash comes from sentiment and positioning data. Technology stocks are the most crowded trade in history. Everybody owns them. Every pension fund, every 401k, every retail investor, everyone believes tech is the safe investment because it's been going up for 15 years. And this universal bullishness is exactly what you see at major tops. Meanwhile, almost nobody owns silver or gold. Precious metals are the most hated asset class. People think it's for conspiracy theorists and doomsday preppers. And when you have maximum bullishness in tech and maximum bearishness in precious metals, and silver is hitting all-time highs anyway, that's telling you the smart money is already positioning for what comes next. They're quietly selling tech and buying hard assets while the public is all in on Nvidia and Tesla. And when the crash comes, the public will be trapped because there won't be buyers for their tech stocks, but there will always be buyers for gold and silver because those are real money that's been valuable for thousands of years. Here's what happens in the final stage of this process that most people don't anticipate. Governments will respond to the crash by doing exactly what caused the problem in the first place. They'll create more money to bail out the system. And this will accelerate the currency crisis and push silver and gold even higher. We've seen this movie before. In 2008, they created trillions to bail out banks and stocks. In 2020, they created trillions for COVID stimulus. And in the next crisis, they'll create tens of trillions. And each time they do this, the dollar loses more credibility and hard assets become more valuable. And eventually we reach a point where the dollar is no longer accepted as the global reserve currency and the entire system built on dollar hegemony collapses. This isn't conspiracy theory or doom prediction. This is mathematical inevitability. You cannot create unlimited currency forever without eventually destroying its value. And silver reaching $79 is one of the clearest signals we have that we're approaching the end game. Now you understand why silver at $79 isn't just a commodity price. It's the market screaming that the dollar is dying and paper assets are overvalued. You understand why technology stocks that everyone believes are safe are actually leveraged bets on currency stability that no longer exists. You understand the mechanism through which rising rates driven by currency crises will crash tech valuations. And you understand that the smartest investors are already positioning for this by selling tech and buying hard assets. The question is what you do with this knowledge. Do you ignore the warning because it's uncomfortable and stay fully invested in the consensus tech portfolio? Or do you act on the evidence and protect yourself before the crash that silver is predicting happens? Most people will ignore this until it's too late because humans are wired to follow the crowd and maintain status quo. But you now have information that 99% of investors don't have or refuse to acknowledge, and that information is power if you act on it. If this revelation about why silver reaching $79 exposes government's inflation lies and why technology stocks are the next bubble to burst has changed how you see your portfolio, if you're finally understanding that conventional investment wisdom is designed to keep you trapped in paper assets that benefit the system, while hard assets that benefit you are ignored and discouraged. If you're ready to stop following advice from people who get paid to sell you stocks and bonds and start thinking independently about how to protect wealth during currency crises, then you need to see what we reveal next, because the technology crash is just one domino. There are other asset classes and other bubbles that are even more dangerous, and understanding the complete picture is the only way to position correctly for what comes next. Subscribe now and prepare to discover why commercial real estate is already collapsing and will take regional banks with it. Why the bond market is the biggest bubble in human history and its burst will destroy pensions and insurance companies. Why the everything bubble built on 50 years of currency debasement is finally meeting reality. And why the only assets that will survive are those that represent real productive capacity or resources rather than claims on depreciating paper currencies. Because silver at $79 is just the beginning of a reset that will reshape the entire global financial system. And if you're not positioned correctly, you'll lose everything. But if you understand what's happening, you can not only survive, but thrive in the chaos that's coming